Let's talk about the top dividend aristocrats. When you pick a company to invest in and you purely pick that company based on how high their dividend yield is, it can be a little bit problematic. And this is because quite often companies will offer a really high dividend yield as a way to sort of compensate for other problems that they have. Perhaps they have bad underlying fundamentals. Or maybe they are offering a really big dividend yield in order to get investors to throw their money at them, and then they will just cut their dividend yield or completely remove it. And obviously this is not great if you are a long-term investor following a dividend growth strategy. One risk with selecting stocks just based on their dividend yield is that you may fall into what is called a value trap. And these are companies that are paying a good dividend yield, but they're not really growing. They're at their last phase of business growth. So they've gone through the startup phase, the growth stage, and they're just they've peaked out and they're not really growing anymore. Or they're growing very, very slowly. And a lot of the time, when a company reaches this sort of area in their growth, they will begin focusing on just being stable, just being consistent, not really adding new products, adding new services, acquiring new companies. They will just remain a consistent company. And they will focus on their financial performance year on year rather than their financial growth. And one fair argument against investing in dividend stocks at all is that quite often the companies that experience really rapid growth are the ones that don't offer a dividend. And this is because they've decided that they don't want to give away their profits to investors, and instead they want to pump it back into their own business and really help escalate and grow that business, which in turn will benefit the investors. So it's a slightly different strategy when you come to dividend investing. So I think the best bet, the middle ground, is to, instead of focusing on companies that pay extremely high dividend yields or companies that don't pay dividends at all, as a dividend growth investor, you may want to instead focus on the companies that have been consistently increasing their dividends year on year on year. As it's these companies that will provide you as an investor with consistent and stable passive income. So these companies that I'm referring to are called the Dividend Aristocrats. And by definition, these are companies that have consistently increased their dividends for at least 25 years. By definition as well, a Dividend Aristocrat has to feature within the S&P 500, which of course has its own entry requirements. And by no means will these companies make you rich overnight. You're not going to put in $100, £100 into one of these companies and wake up tomorrow with a net worth of 100,000. That's not going to happen. But the whole idea is that you put money into these really, really good value companies that have been consistently increasing their dividends. Then you reinvest the dividends that they give you back into the company so you own more shares of that company, and over time this compounds. You keep getting their dividends, you keep getting more shares of the company, and it just keeps getting bigger, and your passive income from the dividends will increase. So I'm going to mention the top dividend aristocrats in this video. And these are the companies that have been consistently increasing their dividend yields, but have also been growing as companies year on year. So by definition, they are true dividend growth stocks. And I also want to show you with evidence today how these companies have outperformed the S&P 500. These companies are all going to be companies within the S&P 500, but I am going to do a similar video for the FTSE 100. So if you want to see that, then click subscribe so you don't miss that video. So the first one we have is one that I am sure you've heard of many times, and that is McDonald's. If you have not heard of this company, I honestly don't know where you have been, but as you probably know, they are a burger franchise, but more importantly, they actually are a real estate business. Over the last few years, we can see that McDonald's revenue has been increasing. So in 2018, they were at $21.2 million. Then in 2019, they reported nearly $21.4 million. So that was up. 2020 did take a hit as expected. People weren't really going out and eating at their restaurants, but they reported a revenue of $23 million or just over for 2021. So they're definitely going in the right direction. They pay quarterly dividends and their current dividend yield sits at 2.1%. And now I just want to show you how their dividends have been increasing over time. So if we look here on this graph, we can see that they have been seeing a steady increase. So every year, pretty much, they have been increasing their dividends for their investors. And that is why they are one of the dividend aristocrats. And the last thing I want to show you is how this company, McDonald's, have been performing against the S&P 500. So a lot of these companies, actually I think all of these companies have outperformed the S&P 500. So what we can see here is the S&P 500 is plotted on the blue line and McDonald's on the yellow line. And I've just maxed out the graph to just show as much time period as I possibly can. And you can see here that McDonald's have absolutely trumped the S&P 500. If we look at over 5 years, again, it's a little bit closer, but McDonald's seem to come out on top a little bit. If we change it to 1 month, you'll see a lot more variation in that. But yeah, you can definitely see that this is a company that are paying increasing dividends to their investors and are growing year on year on year. The next company, so number 2 on this list, is Target. Target are a massive American department store. I'm sure you've heard of them. Even I've heard of them in the UK. We can see here that every single year pretty much they have been increasing their revenue. And of course, revenue is not the only thing to look at. I do know that you need to look at their debts and everything else. But if they're not earning money, essentially, then they can't really grow as a business, nor can they pay good dividends to investors. So it is a good thing to look at just as an initial oversight. But 2018, $72 million. 75 in 2019, 78 in 2020, which was pretty good considering most businesses sort of had a decrease. 2021, $93 million, which is absolutely an insane jump. So that's really, really positive for an investor. Target again pay quarterly dividends and currently the yield sits at 2.1%. And if we look here again, we can see, not surprising as this is literally by definition of a dividend aristocrat, the dividend yield has been increasing year on year and it actually saw a pretty big jump from 2020 to 2021. And the next thing to look at is how has it been performing against the S&P 500. So the S&P 500 again is in blue, Target are in yellow, and we can see a massive difference. And if we look at it across a 5-year period, again, Target has really trumped the performance of the S&P 500. This is telling you that if you invested a lump sum of money into the S&P 500 and a lump sum of money into Target, you would see better returns from the money that you put in Target. But of course, if you know anything about investing, you know that sticking with index funds can often be the sensible decision. Number 3 on our list is Johnson & Johnson, which of course is one of the biggest healthcare companies in the world, and I'm sure you've probably got some of their products in your bathroom as we speak. Again, this is a company that a lot of dividend growth investors will already have in their portfolio, and even people that are not looking for dividends probably have this one in their portfolio anyway. Their current dividend yield sits at 2.45%. They pay quarterly dividends as well, and you can see that they too have been increasing their dividend yield, not so dramatically as some of the other companies, but still increasing it nevertheless. And again, if we take a look at their income statement, we can see that over the past 5 years, they have only increased their revenue year on year. So not only are they increasing their dividends to their investors, they are also growing as a company. And lastly, let's have a look at this chart here. We can see that Johnson & Johnson have outperformed the S&P 500 by a long way. At number 4 on the list, we have PepsiCo. So this is a drink manufacturing company. I'm sure you've heard of Pepsi before. They own Mountain Dew, they own Gatorade, they own 7-Up, and the list just goes on. They even own Doritos. Looking at their income statement here, you can see that again, year on year, their revenue has increased. I'm not actually sure what their earning reports said of 2021, but even so, 2018, 2019, 2020, it all saw a jump in the revenue. They're paying quarterly dividends to their investors, and I think they're paying about 2.6% dividend yield at the moment. And as per all of the other stocks in this video, we can see that they've been increasing their dividends year on year on year, and this year is absolutely no different. If we have a look at Pepsi compared to the S&P 500, it gets a little bit difficult if we max out the graph because Pepsi just becomes this little worm in the corner here and we can't really see what's going on. So we'll look at it over 5 years. And you can see that it's not as clear as some of the other stocks, but if you just look at Pepsi, you can see that even over the last 5 years, they have been gradually increasing in their growth. So that's all positive. And following on from this trend, we now have CocaCola. Again, this company needs no introduction. They obviously have Coca-Cola, but they also have other brands just as Pepsi did. So to name a few, we have Costa Coffee, Innocent, Minute Maid, Sprite, Powerade, and again, the list goes on. I'm sure you've all heard of Warren Buffett. Well, Coca-Cola is a company that Warren Buffett really, truly believes in. And if we take a look at the revenue for this company, it's not as clear cut as some of the other companies, I must say, but I'm sure if you delved further into this, you would see real value in this company. But just taking a look at real oversight of revenue, we can see that 2017, 36, 2018, 34, so it went down a little bit, but then it shot back up to 37 in 19. It took a hit in 2020 as expected, but over time they are growing. This company is paying quarterly dividends, what a surprise, and currently their dividend yield sits at 2.8%. And we can see that the dividend yield has been increasing as the years have gone on. So let's just take a look at the S&P 500 compared to Coca-Cola. Yeah, we can see that Coca-Cola have outperformed the S&P 500. Of course, if you look at year and year and year and compare just years, you'll see some fluctuations, but overall, this does show that Coca-Cola are seeing better returns in the S&P 500. But it's a little bit risky pinning all of your money onto just one stock. That's why a lot of investors like the S&P 500. It's given them the diversification between sectors and between different companies. In at number 6 on this list, we have Realty. Now, this is a big real estate company. And when I say big, let's just take a look at some of the clients that they have. They have 7-Eleven, Walgreens, Dollar General, FedEx, Sainsbury's, Tesco's, massive clients. And all of these are paying them for the land that they own. So they are operating out of real estate that is owned by Realty. Over the last few years, they have reported massive revenues. So 2017, $1.2 million. 1.3 in 2018, 1.4, nearly 1.5 in 2019, 1.6 in 2020. So they didn't even get too affected by the whole pandemic by the looks of it. So they really are growing rapidly. And I'm not surprised with some of the clients that they have. I know that this company, this dividend paying company, is loved by many investors. So now let's just take a look at how their dividends have been increasing over time. So we can see here that they've been gradually increasing their dividends. Again, not by as much as some of the other companies, but they do pay quite a high dividend actually. I believe right now it sits at 4.4%. And I believe they pay dividends twice every year to their investors. Looking at this chart here, we can see that the S&P 500 has been outperforming Realty, but if we take a look at the 5-year chart and the 1-year chart, they've been doing pretty well. The S&P 500, I believe, has been running a lot longer, so maybe that's why the discrepancies here. But yeah, they seem to be a really good company. Let me know in the comments below if you actually invest into this company. I'm going to share the last one with you now, but stay tuned because I'm going to share a really simple and easy way that you can invest in all of these US Dividend Aristocrats in one simple place. The last one is Medtronic. So this is a company, a healthcare company that is the largest in the world in terms of producing medical devices. And I think this company is only going to get bigger because it seems like people are getting sicker as time goes on, probably attributed to our bad diets and poor way of life. But yeah, this is a company I believe are going to grow. I do not currently own this company, but perhaps they will feature when I come to make my dividend portfolio. Anyway, let's see how they've been doing. Over the last 5 years or so, they have been seeing a gradual increase in their revenue. It went down a little bit between 2019 and 2020, but it seems to have picked up since then. And yeah, they just seem to be growing. They pay quarterly dividends and currently the dividend yield sits at 2.5%. And we can see here that they've been increasing it quite nicely actually. And let's just take a look at how they've been doing compared to the S&P. So we've got them in yellow here and you can see that they've been seeing massive growth in their share price compared to the S&P 500. Let's just take a look over the last 5 years. Okay, if we look over the last 5 years, the S&P has come out on top, but I think that because the Medtronic stock has dropped here, it could be a good opportunity to buy if you like the look of this company. I wouldn't suggest trying to time the market and always buying the dip. That's probably not the best thing to do. But if you've had this stock on your watch list for a while, it may be time to start adding them in. Let me know if you own this stock as well. I'd be interested. Okay, so I said that I'll share a way that you can invest in all of these stocks through one simple way. And you can invest not only in these ones that I've shared with you today, but also many other Dividend Aristocrats. Now, there are about 66 currently that are featured within the S&P 500, and you can invest in all of those through one fund. and that fund is the S&P 500 Dividend Aristocrats. And you can invest in this fund just through your normal brokerage provider. So the platform that you use, just search for this fund and I'm sure it will come up there if you're interested. So over the past 5 and 10 years, the S&P 500 index has outperformed the S&P 500 Dividend Aristocrats, but the Aristocrats as a group have outperformed the S&P 500 if you look at it over a longer period of time. If you want to know which stocks pay the highest dividends in the FTSE 250, watch this video here.